So is your business currently hitting a cash ceiling? Are you finding it limiting because you can't continue? Follow my video and I'll explain more. So our mission is to help small business owners exactly like you. So if you're new, please click the bell to make sure you don't miss out on any of our best pieces of content. Learn how to position your business to make it really attractive for funders and or also equity investment. Follow my video and let's explore this area. First of all, what do you need the money for? So the money could be for working capital, it could also be for equipment and further investment to make your business bigger. Allowing more capacity, which hopefully should lead into earning more profitability. Now, what you want to be careful of is debt can be very good, but also debt can be bad. So if you're getting debt into your business because you've absolutely rinsed every penny out of your business via your director's loan account, debt is still not going to fix the hole in the boat. So make sure you're 100% clear on what the actual debt is for and you're not just using it for a lifestyle you can't afford. So debt is not always the best option. Overall, it's normally one of the cheapest options, but you could also be looking for equity investors. Equity investors in layman terms means you are selling shares for a certain amount of money. They will own part of your business and or be entitled to dividends in the future. What you tend to find is equity investors want their money later, but they want more of it, where if you get debt within your business, you'll get a loan schedule for say over 5 years if you're buying some equipment, and you'll pay that back over 5 years, and once you've paid it off, the debt has gone and they don't have any ownership or impact on your business whatsoever. So what type of funding do you need? I mean, this can be a complex area for a lot of small business owners, because how are you meant to know exactly all of the different funding types that are on the market? So the traditional one will be a small business loan, which will be secured or unsecured. Most people would understand that, but there are other types. There's invoice discounting, there's invoice factoring, there's also asset finance, to name just a few. So what we've done is we've created our own book, which is about funding. So take a look at our link below. This will give you various types of funding that are available to you as a small business. And it's okay if you've got further questions after that, click my link for a discovery call below. I'll take on board any questions you have and hopefully give you the knowledge you need to make the best decisions within your business. And what you need to do is come up with a plan. It's all very well and good to say, oh yeah, I'd like that digger, I'd like this IT equipment, whatever, but how does that fit into part of your grand master plan? Every single business should have a business plan of what they're striving for and what they're aiming for, yeah? And that equipment or the commercial property or the invoice discounting for working capital should help you achieve that plan. Because ultimately, why are you going to get a load of debt if you're going to get no return for it at the same time? You're just not going to do it. And what you want to be able to do is use that loan to be able to pay back that loan and additionally make some more money. Now stop! I can hear you saying, it's okay, Michael, we only build up money in our business and spend what we've got. I can't argue with that, and that's commonly known as bootstrapping. And bootstrapping is something that's very sensible. You build up the cash and then you spend it. But you may have an opportunity that you need to jump on straight away. So if you've got a construction project, they're not going to sit around for 12 months for you to build up a project. You need to maybe go and buy a digger. You need to go and buy some specialist tools, which you could rent, but also you could buy an asset finance. If you say no to that project, you never know if projects like that are going to come again or they're going to continue with other companies. Each case is completely unique. So make sure that obviously you're not spending beyond your means. Obviously make sure that that loan and that asset is going to turn into more money, or that's what the plan is as well, rather than just using any type of finance to rip more money out of the business because you're spending more than you're actually earning, which is a big hole in your boat. One clear guidance that will be really handy for every small business is what is your credit score. So from a credit point of view, and that basically means how people would view in lending you money, this is how sexy or not that you are. So there's various different credit agencies, but normally they're like 0 to 100. And you can then assess how good or bad you are. They also have letters like we used to at school with A's, B's, C, D's and E's. So what's going to be quite important from your perspective, even before you start this loan facility, is what is your current credit score now? And as a gift, if you want to know what your credit score is and you want us to do a capital report on it, drop me a message on here and I'll be happy to prepare a credit report for you. We will need some information about your business, but we'll be happy to do this completely free of charge. Your credit score will determine how much people are going to lend you and also the rate. So if you've got a low credit score because it's got loads of red flags on it, and you could be a D or an E, you are going to pay more for the loan or potentially not get one at all. But if you're an A or a B, you will get a better chance of actually getting an offer of a loan and or help a reduction in rate as well, so it ends up becoming cheaper. Having an eye on your credit score and tidying this up can have a major impact in your business. We've been working with a client recently who's looking to grow really aggressively via acquisitions, and they can be really quick, really beneficial, but they do come with a fairly high amount of risk. Normally when you buy a business, you'll pay down some money to start off with, and if it's structured really well, you can fund it out of profits, so you don't need any capital to pay of the exiting owner. Now, what we've done recently with one of our clients is help them secure more finance. So they needed 150,000 for the first deposit, and we were managing to source this by 2 different types of loans. These 2 different types of loan have helped him then buy the business, which will then increase the value of his business and increase his cash flows, increase his profit. And once he's paid back the owner out of future profits, that means his business is growing a lot quicker. So after acquisition 2, 3, 4, 5, and the cash flows and the profits are looking really good, he could then fund further acquisitions out of cash flow. But let's be honest, if you've done 4 or 5 acquisitions and you've seen your profit and your turnover go up like that, you are going to look a hell of a lot more attractive to future funders, which will give you more options to help scale your business even further. It's highly possible that we will be able to help you with funding for your business and also review your plan. So if you could do with any help in this, we'd be more than helpful to review what you've got and also come up with some recommendations. If it helps to have a chat first, click my discovery call link below. I'll be happy to help you as much as you need, and I promise there'll be no pushy sales pitch. If you're looking at funding, please also have a look at our book, which is specifically for funding, that was designed for small business owners exactly like you.